Welcome to the Private Lenders Podcast with your hosts from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by hardmoneymastermind.com.
Hey everyone, Chris and Jason here, Private Lenders Podcast. Thank you for checking out the show. We have a special guest who I'm about to introduce. So Jack BeVier is one of the principals of Dominion Financial and Dominion Properties here in Maryland. They do a lot of lending. They own a lot of properties. And Jack is, not everyone has experience in all different kinds of lending and capital and everything else, real experience. Basically all the stuff that when people are bragging about their deals on LinkedIn that they don't actually talk about, the behind the scenes stuff. That's the point of today's show. Jack, thanks for being with us.
Yeah, absolutely. Thanks for having me. It's great to see you guys.
Yeah, for sure. If you wouldn't mind, could you give the audience a little intro, a little background on you and your companies?
Yeah, sure. The Dominion Group of Company was founded back in 2002 by my partner, Fred Lewis. I came in 2007, and we have a private lending business where we lend to fix and flip investors as well as originate DSCR loans. We also have a real estate company that buys small residential projects in the Baltimore metro area. And so we flip houses. We also have a rental portfolio in Baltimore. And then we have a property management company that manages the rental properties that we've added to our portfolio over time. So as it relates to what we're going to talk about here today, the Dominion Financial is the lending company, and we do both bridge loans and DSCR. We keep the bridge loans, the RTL loans on balance sheet, and sell all the DSCR loans servicing released. So it's been a fun, exciting, difficult past 4 or 5 years, and happy to talk about that experience with y'all.
Yeah, 100%. If you could you give a little more background on the growth and evolution of Dominion Financial? Because it has changed and grown like substantially over the years.
Yeah, definitely. Back in 2002, when Fred started it, we were an asset-based lender in Baltimore. If we would buy that house for 50, we'd happily lend 40 on it. And that was the business model. It was 15% interest and 5 points, mostly unlevered from our perspective. It was just kind of personal capital raised, and then slowly, organically over time, raised friends and family money behind that. Got our butts kicked in the Great Recession, had a high default rate as a result of that asset-based lending approach, and did workouts for like 4 years straight. Fortunately, amazingly made it through. And then that experience really kind of like informed our perspective on how we wanted to grow the business. Because it was kind of a perfect A/B test, right? Like everyone was underwater, but not everybody defaulted. So, when push came to shove, it really kind of showed us like who's going to pay and who's not. And so we wanted to grow the business around the folks who were going to still work with us and not fight us if, stuff was going sideways. And so we started growing the business, somewhat differently, pivoting more towards like experienced real estate investors, a little bit more focus on financial strength outside of just the quality of the deal. And so just grew the business from 2010 forward. We expanded outside of our backyard in Maryland into Atlanta in 2012, and then just kept adding states from there as fast as we could figure out how to underwrite them and figure out loan docs and title. So by 2018-19, we were pretty much national. In 2020, late 2020, we added the DSCR product because when the rates came down to be competitive with banks, we saw, with our real estate hats on, we saw how advantageous working with the DSCR loan product was relative to the pain of working with local commercial banks. And we were like, everyone's going to want this. And so we added the DSCR loan product to our business in late 2020, and went through a big growth of hiring, big spurt of hiring, broke our systems and processes multiple times over the years. And so yes, fast forward to today, we've got about 180 employees just in the lending business, and we do about 90 million a month. About half of that's RTL loans, fix and flip loans, half of that's DSCR.
Wow, that's a heavy slate.
Yeah, it's been fun. It's been really fun. We can't help ourselves. We're a growth company. We like to grow. We grow because, we get bored, and then, it helps us. We hit new inflection points. We get to learn new things. We get to make new mistakes and, screw stuff up and hope it doesn't kill us. But, that's what we think is fun. So that's why we do it.
Okay. You got something, Jay, or want me to jump in?
Okay. So little background, the majority of our audience is, uses their own private capital. Maybe they have a fund, maybe they raise money from friends and family. A lot of our audience is anywhere between a few $1 million deployed to like $100 million deployed. And not that nobody uses institutional capital or kind of creative ways, but the majority of the stuff that we talk about is exactly what we know, is what we do every day. Use your own money, turn this into an investment vehicle, things like that. How would you compare yourself, like more of a Torak or a Rock or someone like that, one of those kind of bigger outfits that I think a lot of real estate investors and other kind of larger hard money lenders would just who would you kind of compare to that maybe some people know, just so they can kind of relate this through the conversation?
Yeah, sure. So, by the way, having that less than $50 million portfolio to run, the $3 million to $50 million portfolio, in my opinion, that is the best business, best quality of life, for money made per hour of work, plus you get to do deals. It's just the best thing going. And so I have we have a lot of love for that business model. We grew just because because we also get some excitement out of trying to see if we can go pick off somebody else, right? And put our name next to those bigger guys, right? So at our core, we're a local hard money originator who just wanted to keep growing and couldn't help ourselves. So I would say that we have the background of a local originator, but then we've had to learn a lot of capital markets stuff to figure out how to grow, right? Because you just have to figure out the capital. None of us are rich uncles. So we're trying, so we're and so now because of that volume, we're trying to put our name next to guys who are generally owned by institutions these days, right? We're trying to compare ourselves to the Lima ones, Lending ones, Kiavis, Rocks, all those guys. And, their business models there's actually a lot of variety within the business models. Those are not all the same just because they're all institutional. The white label table funding guys are funded and operationally completely different than the balance sheet RTL lenders. And the amount of institutional capital and the effect that that's had on the kinds of business models that have existed, which we all now as smaller guys have to compete with, is an interesting topic that we could dig into. But anyway, yeah, we're basically just a bigger version of a local RTL company that's trying to figure out capital markets, or has figured out some on the capital market side to grow.
Yeah, I got a bunch of things that are coming to mind, and interestingly, we'll definitely dive into some risk management type stuff, because I know that you, at heart and the way you think, you're a real estate investor. Mm-hmm. When you talk to you talk like a real estate investor, and you manage risk and cap the downside and keep an eye on a lot of economic stuff. And so I'm curious as to how that risk management applies to the big stuff that you're doing. So a couple, we'll get there soon. So one thing that I had in mind, first of all, I think DSCR is a very good product. I think that the industry needs it. The banks weren't doing investment rental properties well enough. DSCR is an important product, and I think it should stay around for a long time. The rehab loans, now called RTL, in the institutional side of things, I have questions about because some of the terms and the leverage and the 90 loan to cost and a 7-figure loan that you see people on LinkedIn chatting about, not that they shouldn't be bragging about their deals. I mean, they're, a W-2 commission originator, he's promoting his business. It's fine. And that guy who's talking about that has no risk in that deal. However, when one of the New York-based capital people that have all, approached us trying to give us money over the years, when you sign that, what's it called? MPLA, mortgage purchase loan agreement.
Yeah,
sign that, start selling them loans. Anybody in the audience who's just running, a 10-person lending company like ours, And they're like, well, I don't have risk. These are their guidelines. They send it to me. I sign the agreement, and I'm going to send it on over to them. I can charge more. I can charge less. And once it's out the door, my risk is gone. Is that true?
No, that is definitely not true. The exuberance of Wall Street for the RTL paper is like obvious, right? Like they want, more and more of this like short-term paper. The default rates have been relatively low, and absent fraud, they've been great yields for institutional capital. And so there's a lot of demand for that kind of paper from institutional capital. The MLPAs, though, the master loan purchase agreements that you sign up with when you're working with those counterparties, are essentially an allocation of risk negotiation. And if you just take what they send you and sign it, you're signing up for a lot of risk. On the DSCR side of things, there's early payment default. So if any borrower that defaults within either the first 3 or 6 months is typically what you're negotiating between, that loan gets put back to you. You have to foreclose on it or resell it, or and it's not worth 100 cents on the dollar at that point, regardless of the LTV or how good you think job you think you did underwriting it. Certainly also, like if there's any fraud that took place in the course of that loan, this is one of the most misunderstood things is if there is fraud in a loan that you sell, one of those like institutional counterparties, it does not matter if you knew about the fraud. It does not matter when that fraud occurred. It does not matter when the counterparty who owns that loan finds out about the fraud. It is market that if fraud, put the loan back to the originator and it's theirs to deal with, right? And those are where you take like big hits, right? So you're like, hey, I'm killing it, man. I'm scraping 2 points on this thing. Like I making 2 points, no risk, making 2 points, no risk. You get put back a fraud loan where and you're lax about your risk management because you don't perceive that there was much risk there because you didn't have to send the wire yourself. And you get a little lax, or your operations people get a little bit lax because no one's talking risk management every day. And you get put back a fraud loan where you lose 30 points, 30, 40 points in the loan. That wipes out a lot of profit in one fell swoop. And it also makes your life hell because you have to work out a fraud loan. And that's just like personally very painful to do.
And who has money for that? Like we all manage investor capital and our own. Like I don't have investor capital to buy bad loans. That would be exactly. that would not be an easy raise.
Yeah. One of the gating issues of even getting signed up with one of those counterparties is that they were like, hey, I might have, what they're perceiving is like, hey, I'm doing business with this guy and I want to be able to put loans back to him. Is he good for it when I send him a repurchase request? And so they're underwriting you based off of your ability. That's the reason that they're doing business with you. Not because they think you're a great originator, because you're good for it if shit goes sideways, because they're going to come, they're going to force you to repurchase that loan, and they want to make sure that you're good for it when they put the squeeze on you. And they do it, by the way. And like I have to repurchase loans every month, given the volume that we do. So like it's part of the business that you end up just reserving for.
Is that the same setup if someone just brokers a loan?
Depends on the brokerage agreement, right? Like the white label funding guys who are working mostly with brokers for smaller originators. Yep. Those brokerage agreements, the counterparties try to put some teeth into it. There's a little bit less expectation that you're good for it, right? Because because in general, those people's business model is to work with brokers. They do a bit more diligence on their side, really because they know that the counterparties aren't quite as good for it. Will they still try? 150%. They will still try. They'll still try to, they'll still try to, take you to the mat to avoid taking the loss themselves. They just have underwritten a little bit, lower likelihood that they succeed, but you're still going to have a fight.
I mean, I've read one of those agreements. It was a few years ago from one of the big names in the industry, and promising that you have X amount liquid specifically for this purpose, and you're going to buy this back, and this is our agreement, and if you don't like it, we can litigate it in Manhattan. And I'm like, nope, I'm going to go litigate with Wall Street people in Manhattan. I don't think so. We're not signing this shit. Yeah, interesting. So like an example, I know you're talking about fraud before and DSCR, and I want to repeat that. I think DSCR is a product, but that lending company that got involved with all the local stuff, the big fraud, that was like $50 million or something like that. They're gonna have to buy that back. How they have money for that?
Yeah, I think that's kind of like what's happening right now is the guys who ended up with those loans, whether they were on an insurance company balance sheet or in securitizations, who are now deciding whether it was fraud or not and putting those loans back to the originator, who's then calling the brokers or other private lender guy who was, coordinated the whole thing and talking about how we had a really bad day. Right? Like we all together here have had a really bad day. We have to figure this out. And right now there's negotiations happening of like which of those loans are going to get put back on what time frame, on what terms. Does the guy have, is the guy, and you're getting a lot of originators being like, yo, if I took all these back, I'm out of business. So like,
yeah,
I can't, so let's try something else. Right. But it's been that was a very bad situation for the market. And as a result, I think you've seen pretty much an immediate industry reaction shifting focus towards risk management, whereas that was just not the topic of conversation a year ago.
Yeah, no, I could definitely see that. And they fluctuate, like if we're talking about RTLs, like the LTV goes down because something happens. And then, a month or two later, it's creeping back up. Oh, we're doing over 90. We're doing 92.5. We're doing 95.5. And I'm looking at it like, if that defaults with a big construction component and an incomplete job, and you're at 92.5 loan to cost, you are going to lose your ass. Are you prepared for that? Mm-hmm. Is that what you want to do? And at the same time, like we have to, we see it all the time, like especially around DC for a good run there, that like if the right loan amount is $500K on a piece of property, say, and they don't go with our offer because they have to bring way too much cash to close, and they close with somebody else's 625, and we're like, what? How are we supposed to compete with that? Yeah. And also, I think it's problematic sometimes for the borrowers because even though they want to bring less cash, it might not be in their best interest. Maybe they're getting in over their head. Maybe this financing is enabling them to get into deals that they shouldn't be in.
I think that's very much the case, right? Like no one wants to hear it at the time, least of all the loan officer, right? Who's just getting paid commission and losing the deal if it goes elsewhere. So like that guy is like pressuring you, like, fuck risk management. Like, we're not going to be able to compete, because you aren't willing to do that. And only history gets to tell you whether you were, whether that was the right decision or not. And even, and sometimes the market just bails you out, right? Like back in 2019, I thought that things were getting so competitive, right? The rates were so low, given where the advance rates were. I was like, dude, this industry is running on a razor's edge right now. You know what? 2020 is, we were like, 2020 is going to be a readjustment year. And then COVID happened. Right. And interest rates went down and real estate prices shot up 20% and everyone got paid off, right? Like no risk management has not been rewarded in 18 years, So like, it's just not been, the flavor of the day to be the bearer of bad news or for anyone to be prudent. And frankly, no one's gotten punished in a really long time. Like, regardless.
Not enough.
So, not enough.
No, that's why in our niche, it's not as drastic as subprime because Jason and I were both in the conventional lending world at that time. We started HMB at the end of 2007. So the timing was good in that regard. But we saw what was going on. And even in our 20s, we're like, this lending is crazy. It seems like nobody's responsible. Like who's going to end up holding the bag at the end? We could even identify that then early in our career. And it looks a little bit like that in investment lending now, although not nearly as extreme, in my opinion.
Yeah, the DSCR side of things, what I think has gotten a little out of hand on the DSCR side is the appraisals. Like, you do a cash out, if in a purchase transaction and it's an actually arm's length purchase transaction, there's the presumption of arm's length and there's a bid in the market, and actually a willing buyer who's willing to pay this. That's a little bit easier. On either rate and term, and particularly on cash out refis, it's a lot harder to detect what V is. And the power that the appraisal industry has gotten in being able to, the discretion that the appraisal industry has been able to put in their own hands to label what V is, to me is insane, is out of hand. It is it is the biggest risk factor and the biggest lesson that we did not learn from 2007, 2008. We put an appraisal management company in between as if that was going to be enough, because the stories got popularized of the appraisers getting paid cash under the table, right? And so we said, hey, we're going to prevent that. The issue is, in my opinion, though, is that they're still, I just don't think, good enough at their jobs, frankly, to be the final arbiter of value. And as a result, we happen to be very risk management forward in the way that we operate the business. So I do manual internal appraisal reviews on every single appraisal that comes through. And my team flags north of 10% of appraisals that come through that were ordered through an AMC. Like, nothing, no funny business going on, just pure appraiser incompetence.
Right.
And so, we're in the New York's buying a loan that, because it's a 70% or 75% loan to value, when in reality it's a 90 or 95% loan to value loan. And we haven't seen a soft economy yet. And, I think that over the course of the next year or two, we're going to start to see a lot more pushback where New York is pushing loans back to the originator, because it turns out that they originated a 95% loan to value loan, and they look for arguments to get that bad risk off of their balance sheet. I think that's next.
Yeah. And in that arrangement, and I learned this lesson from a guy who's done business and invested with us for a long time, is like, you always want to be the smartest person in the transaction. And when you're talking about that relationship, the money is the smartest person in that transaction. You signed their agreement. If they want you to buy it back, you have to buy it back or fight it or close up shop. And so,
and fighting one of those counterparties is like, you're not going to win.
No,
like they've got general counsel on staff, and they're just going to bludgeon you with legal fees until you just buy the loan back. So you're buying
the loan. They wrote the agreement 100% in their favor. And that's what I think. Sometimes I kind of feel bad for some of the people in the industry who aren't aware of this and who don't have these conversations, and things we talk a lot about running an investment vehicle or you're running a mortgage company, because in our industry, you have both options, right? And you've done both. And, my brother used to work for a company in Colorado, and they started out doing all selling everything. And they were doing it exactly the way the capital told them to. Here's your guidelines. Here's your pricing. Go have fun. And so after a while, the owner of the company was like, I like this business model, but working with these third-party capital people is a total pain in my ass. I'm just going to do it with my own money, because he's a very wealthy guy, a lot of liquidity. But the problem was, he was doing it to those institutional people's guidelines. It's the only way he knew how to lend. He wasn't lending like us and how we underwrite and manage risk and manage defaults every day. He was just doing it like the institutional guys. And he was smart enough to realize, I'm going to lose all my money by doing this.
Yeah.
So he stopped and closed the doors and remained rich.
Yeah.
Good for him.
Yeah. I think we probably have at least 10 MLPAs in place. And so our goal is to have access to every DSCR program that exists. And then when a borrower comes in the door, I can match them up with the best execution, right? Like, I know that if they put this scenario, that buyer, that's the best pricing in the market, period, hard stop. Like, that's part of our value proposition. So we were underwriting to all these different sets of guidelines, right? And we started getting early payment defaults. Like, people literally would take out the loan and then never make a payment, right? Like, sure. and then we get tossed the keys on that stuff. And so we're like, hey, what's going on here? Why did that happen? And it was painfully obvious that that FICO mattered, right? As it related to this risk, FICO mattered. Mm-hmm. And though there are guidelines where where a borrower with a 620 credit score could get a DSCR loan, albeit for a higher interest rate, the percentage of time that loan defaulted immediately was so high that I couldn't make money in that segment. So I had to put our own overlays because we were getting too many early payment defaults in the sub 680 FICO. And so I'm like, hey, it's just not profitable business. Yes, I'm aware that Wall Street will buy some of those loans, but when they put it back on us, I can't make money there. So like, and I'm not emotional about it, right? Like, it's just like, hey, I make a point on selling the loan. What percentage of time do I not, do I have to buy the loan back and I don't get my money back? And I do the math equation on that and decide whether that's a segment we want to be in or not. And so we ended up doing a company overlay where we're just like, hey, we're just not willing to originate below 680 FICO. I've got 8 counterparties that'll buy below 680 FICO, but if they're willing to be in that space because they get to put all the EPDs back on me. So what they're left with is actually probably pretty good business. But from the originator's perspective, I got to do different math than that. So anyway, yeah, it's just same lesson.
Yeah, I mean, that's risk management. That's professional risk management. I always wonder, since we're not involved in that space ourselves, we just know of it. Like, who's holding the bag at the end of the day? We know one of the people is the lending company, potentially. Lending company could be. You got the next level, the people who are securitizing and aggregating and all of that. And I don't know if they have recourse on this. Do they have risk? Is it an end investor in the secondary market who's going to end up, like, I just don't know the dynamics of who's going to lose money here based on these bad deals.
Yeah, so the 2 main outlets for DSCR loans are either a securitization shop who's going to go do a securitization, issue bonds, and then take the risk and then retain the risk retention piece, which is the riskiest part of the stack. Usually it's 5%, at least 5%. And so that securitization shop who sponsored that securitization and retained that 5% of the deal is on the hook for those losses. So that's who you're going to be fighting with if there are losses to be taken. They're the ones who have a vested interest in putting it back on you as the originator, which, by the way, like, pretty amazing economics, right? Like, that's the temptation of working with the institutional capital is if you can do a securitization, you can get 95% financing on the loans that you originated, not, and like bad boy recourse, not full recourse. Like, you can get non-recourse financing at 95% if you're willing and able to jump through all the institutional hoops. So like, it's a very tempting idea. But so anyway, that sponsor of the securitization is the one who's got that risk retention piece. They're the ones who's holding the bag on the securitization deals. Alternatively, DSCR loans also end up on insurance company balance sheets. And they're just, good yielding notes that the insurance companies buy with, the money the premiums that we're giving them. And those are, this insurance company hires a servicer, and this servicer sends the insurance company a check, and it's as simple as that. So you also have insurance companies, mostly life insurance companies, that are holding a lot of DSCR exposure also.
Well, so you said, you guys will do close to about $1 billion, in volume. Obviously, we hear about Kiavi and all the amount of deals that they're doing. Is that sustainable? Like, the amount of deployed volume, assuming has increased year after year, but as the market potentially softens, like, does everybody believe that there's still going to be that much volume out there?
Yeah, I mean, if you believe, Forecasta's data is I think some of the best. SFR Analytics also has good data on market size. Yep. And I'm going to misquote the number, but it's something like, I'm going to misquote the number. It's something like 14 billion a year, right? Kiavi's like 8% market share or something like that. We're like 1% market share. Like, so it's still a very, very, very fragmented market. Like, Kiavi feels like the 800-pound gorilla, but they're only 8% of the market. So I think it's still a very, very large market. And so the idea of so even if the pie gets smaller, my argument is that even if the pie gets smaller, I can still grow if I'm like a great operator, right? If I'm better than all these other competitors, and I'm still competing with mostly small businesses. So and sometimes just guys, who are just retiring. So there's an opportunity there for somebody who wants to grow to be able to. It's not nearly a mature market. It's nowhere close to a mature market, right? That said, I do, and I think the pie should have gotten smaller, because I think the number of transactions has gone down as just the number of real estate transactions has gone down. But the pie's gotten bigger because we've been stealing market share from the banks. And so like if the banks had retained their market share, I think the pie would have actually gotten smaller over the course of the last 5 years. But instead, it's the commercial banks that have ceded, the vast majority of their market share to the private lending space. We're getting close to probably running that out. Like I think that the commercial banks don't retain too much market share still. And so like I think that, we're getting close to having all of the market share within the private lending space. And then it will fluctuate, there will be pressure because it fluctuates based off of just purely transaction volume. The other argument that everything's going to be fine though, is that aging housing stock, you're always going to have flippers. Cost of new construction is really high. The only way to create affordable housing is by retrofitting old houses. And so like with the affordability pressure and the fact and the land zoning issues that prevent new permits from being issued, the idea that the rehabbing old houses is like a super safe place to be, and I buy that. I subscribe to that philosophy. So
yeah, I know, I do too. And
same.
It's very geographically localized. It's regional. I mean, there's areas of the country that no houses were built before the 70s, and it's like, well, a lot of those might not need to be retrofitted or renovated yet, or maybe they're getting to that. And then there's other parts where it's a lot older and it's heavy. And it's the same thing why DSCR might be heavier in one market compared to into another market. Baltimore, maybe more stuff in Baltimore for DSCR than DC. I don't know, units, sure. But maybe the loan amounts are higher. So, and I mean, we only see, it is interesting because we're so heavily focused in kind of mid-Atlantic stuff. But, when we talk to Mastermind members and people in our audience that are in the Midwest or in other areas, and the way that they're structuring deals is complete opposite. And it seems crazy, but it's like, that's what works. I mean, I was talking to a guy the other day that has 18 million of his own money deployed in the Midwest, and he does 30-year loans with his own personal capital. And, he's getting 13-14% rates on these things, and they still cash flow. And I'm like, interesting. And he's like, I just like to do set it and forget it loans. And I'm like, well, what if you ever have a liquidity crunch? And he's like, well, I'm bringing in 6 figures net every month. And if I need to sell some of these things, I'll sell some of these things. So I was like, good point. Then, it's interesting. But I kind of always thought, and maybe I'm wrong about this, but I've kind of had this opinion over the last 10 or 12 years where it's like at some point, mostly not necessarily DSCR stuff because we don't live in that space that much, but the fix and flip stuff, I was like, at some point, some of these jackasses will do just bad deals and they'll tank and they'll go out of business. But then I guess there's somebody right around the corner that will just eat up that market share. So it doesn't really.
The interesting part is that that hasn't happened yet. We haven't seen people going out of business. It's just kind of like hanging it. Like we're all underwriters, right? We can take a look at a loan and know if it's a bad one that's going to lose money if it defaults. And there's a lot of those hanging out there. And there's buybacks that are happening that aren't being talked about, but not to the scale of taking a company down. You hear about that one. It's happened a little bit. Like AJ from the mortgage office, he's always talking, like he likes that topic. Because those are his customers, right? And he calls them like the lenders who are no longer with us. Switching gears for a sec, I have a question about RTL stuff, and then we'll get into the credit line things that we were talking about off air. All right. So I'm got it on the DSCR and all of that institutional money. You mentioned that you keep all of the rehab loans in-house on your balance sheet, and you're doing 40 or 50 million a month. What is that sales and marketing and origination process looks like? Like that's a monster.
Yeah. We have and it's all direct to borrower. There's no broker, which is unique because a lot of the larger RTL guys do work broker, but we think from a risk management perspective, we want to have a direct, relationship with the borrower before the loan originates.
Yep. Oh yeah.
So, anyway, we do a ton of direct mail. We do a ton of pay-per-click. We do a ton of social media advertising. We got a 5-person marketing team that punches way above their weight class, in my opinion. So it's, big spend that we are like, try to really dial in KPIs where, we use Salesforce to manage all this stuff, as a CRM. We also use it as an operating software for loan originations and servicing. We needed something a system that scaled. We were very happy on very happy on Excel and Monday.com. We loved it. It was great, but we broke it with volume.
Sure.
But anyway, there's 25 loan officers that are fielding inbound calls, or fielding inbound leads, whether it's web forms or calls, and then we pre-approve a borrower, get basic financial information from them, try to screen out folks that we just don't think are financially qualified or don't have the operating capital to successfully do deals. And then we have an underwriting team that actually is doing the valuations themselves. So we're not doing I'm not relying on third-party appraisals, as I talked about.
Nice.
I don't have a whole lot of faith in that system, in that paper that they're producing. So anyway, we have 11 people who are in-house underwriters who are actually underwriting the deal, preparing the quote based off of the borrower's financial strength, and then send it to me for approval. And I still sign off on every loan quote that goes out. And it's probably an 80% conversion rate from something quoted to it closing. And then we have a processing team that takes the deal from quote to close in, as little as 2 days. So we're still able to deliver that, hey, call me on Monday, we can close on Friday service. Yeah. But we set the system up to scale.
And that's a legit operation, and not surprised, knowing you and how you approach this stuff. Go ahead, Jay.
Yeah, and I'm sure you have massive repeat clients, which really fuel a lot of this. And, back in the day, pre-institutional capital, we could do, 20 deals a year for the same guy over and over and over. But our product, most of our listeners' product, the better borrowers just outgrow it. And that's fine. And I'll tell people that. It's hey, listen, you're going to get to a point where when someone needs something that closes in a day or two and they want local, easy and fast, you'll still get those deals. But you can't be upset when, they outgrow that. And until that larger firm that can spit out cheaper capital, something happens to them, it is what it is. Keep it moving and bring in new people.
Yeah. I'd say the people who become higher volume, the temptation of paying less is they just can't help themselves, right? If you offer me money for cheaper, it's the same green money. I'm going to take it cheaper, right? So something that we had to do in wanting to scale was hey, we need to get our cost of capital down. Otherwise, we just won't be able to get those enough of those folks, right? So if you want to compete with Kiavi, you need to have Kiavi's cost of capital. And so that was kind of a necessary evil to it. And then the trick though is can you scale without becoming a bank, right? Becoming institutional and slow and the service level degrading. And that's hard, right? We focus that is our singular cultural focus within the company. So we think we do a pretty good job of it, but our goal is to try to be that cheaper cost of capital at the same Main Street service level, but that's really, really hard. And so there's still a lot of market share and a lot of fallout business from guys who get left standing at the altar by these institutional guys. So
we get a ton of deals that way.
Yeah, I'm sure. So there's still very much, at the end of the day, your cost of capital on a hard money loan does not make or break that deal, right? You should be getting deals that are 20% plus, minimally 20% returns, right? So whether you pay 11 for your money or 14, that shouldn't make or break it. And so the deal still works if you go to the local guy. Otherwise, the deal didn't work at all, So it's not as if it's necessary to work with one of those institutional lenders.
Yeah, I want to switch gears real quick because I know that you do have a stop time. You mentioned that you're working out a new product, or now you're a couple years into a new product focused on smaller hard money lenders that are constrained by capital and looking to leverage to get some more liquidity. Could you give us the breakdown on that again?
Yeah, sure. So the basic thesis was after 2022, when all the rates went up, when rates went up, we also saw a lot of pullback in lending in the lender finance space. Western Alliance was very big, a reliable source of warehouse lines. Churchill's very long in the business, but they've really grown, and so they're not serving the smaller guys anymore. And then other than that, our experience has been that like you may be able to like drag a banking relationship into doing a lender finance deal for you, where they're lending secured by the loans that you're originating to help you grow. And that's what we did for more than 15 years. But it was a slog, and the pain of working with the commercial banks is it sucks. And it hasn't gotten any better. So the thesis was like, hey, the private lender who's working with less than a $50 million balance sheet, this is like the best risk profile ever that no one is paying attention to, that is completely underserved. These guys have $10 million of their own money that they are deploying into first lien mortgages secured by real estate, and they can't get a loan on that, and they can't get a business loan, like, or the business loan that they can get is like, a person, $1 million line of credit from their local bank because they have a deposit relationship there. Like, how underserved are these guys? So anyway, we put a program together where essentially the primary use is to like smooth out cash flow. Our experience growing as a lender was that cash flow management was the most painful part of the business. We got 2 weeks heads up that like payoffs were light or originations were heavy. And the prospect was, I have to go call, our accountant would call us and be like, hey, can you push off loans next Friday? Cause I don't got it. Like I don't have enough money to fund it. And the answer was hell no. Like, absolutely. I'm not calling borrowers and telling them to push that I can't close, right? That was the kiss of death for the relationship. So, our thesis here was that like private lenders need access to money in less than 2 weeks, and they need it without pain. And so we put together this essentially hypothecation program, or lending with notes as collateral. And we can get private lenders money, and then you call me on Monday, we can get you money by next Friday, secured by the loans that they've already originated. No overlays on eligibility criteria, and basically it's like 75% advance rate on the loans that they've already done. So it's not like rocket fuel from a growth perspective, but it's great from a cash flow management perspective. And we've done about 50 million of it in the past 2 years. And I've gotten it approved by our warehouse lender. So now I can continue to grow that. So we've been reaching out to small private lenders to see if there's a need, see if this is something that they would want in the toolbox.
No, I bet there is in our audience. I'm pretty sure, in fact. So you're doing 75% of the face value of the note. That's what people can expect.
Yeah, exactly.
But is it one off, or is it their whole portfolio?
It's one off, deal by deal.
Yeah, deal by
deal. However much you need, you need a couple $100,000 next Friday. Cool.
Do some assignments, send us some paperwork.
Yeah. And like without the pain of like the bank compliance or negotiating a big $5 million line of credit document, it's just deal by deal, money in 2 weeks. It's 10 and 1, it's 10% interest in 1 point. The point that pays for, there's no other fees though. The point pays for legal, underwriting, the title bring to date, docking the thing. And so for us, it's 10% money that I just think is like a phenomenal 10% return.
Yeah, no, it is.
Yeah, with that risk profile, it makes sense.
We've done that. We've done that before ourselves, except our rates and terms were higher. So the problem is
the thing is, when cash flow is the issue though, like the rate doesn't. The rate is not really the driver. It's no one wants to pay a lot for their money. Everyone wants to put the cost.
We had a good thing going when we had like 3 million deployed with one outfit, and then they were like, "Yeah, this is expensive," and I was like, "I get it," and we weren't really wanting to go much cheaper, type of thing, and it didn't make. But no, there is a demand, and I actually think like 10 and a lot of people raise capital at double digits, right around 10% from private capital, or that's what they want to deploy their own personal money at. So 10 and 1's not bad.
That's not where we launched it. 2 years ago, we launched it higher because it was purely equity. But once we got our warehouse lenders comfortable with the product, I've been able to get some back leverage on it. And so we're trying to bring it down. I mean, my goal is to get 100 million out, because then I think I could drive my cost of capital down even further and get it out at 9 and 1. And then I think really people would be very interested in it.
Yeah.
Because at the margins, that's a big chunk of your profit that your capital's asking for. So like, it matters. It matters.
If lenders who are watching or listening want to reach out and look into this, how should they reach you? Where can they find you?
Yeah, sure. My email is probably the best. It's jack@thedominiongroup.com. My cell is also 410-353-5667.
Awesome, man. We appreciate you taking the time. It was a good talk.
Oh, absolutely, man.
You have the answers to a lot of the questions I've been meaning to ask somebody. So I'm glad we did this.
It's my pleasure.
And I have to say, I think the answers were all pretty much what I suspected. And again, what people aren't talking about on social media in the private lending world. So no, that insight was great. And of course, we'll share this all with you, and feel free to put it wherever you like. I think it was a really good talk.
Awesome. No, great to chat with you guys. Always a pleasure.
Good stuff. Thanks again, Jack.
All right, guys. Thanks so much. We'll see everybody next week.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.